As cryptocurrencies are hitting new highs, the tax season is approaching. In this video I cover all you need to know about crypto taxes. I also go over some of the changes in crypto tax reporting. I also go over some simple strategies that can help you minimize taxes on crypto. This way you will have more money in your pocket and not in the government's. If you're new here, welcome. I'm Andrei and I talk about investing, crypto and other economic topics on this channel. The first thing to know is that the IRS knows that you transacted in digital assets. Most of the time they receive 1099 forms from the crypto exchanges where they show your numbers. Also, the 1040 form asks a specific question about digital asset transactions. The IRS included it there to make sure that people can tell that they forgot about it. Here's some questions to ask yourself. Did you sell crypto for US dollars? Did you exchange one crypto for another? And so on. If the answer is yes to any of these questions, you have a taxable event. Crypto is taxed like any other property and is subject to capital gain taxes. If you invest in stocks, you know that there are short-term and long-term capital gains. If you sell crypto within a year, your earnings are short-term capital gains. They get taxed as ordinary income. Also, don't forget state taxes if you live in the US. Conversely, there is tax on long-term capital gains if you hold crypto for 1 year or longer. The tax rates on these gains are much lower compared to short-term gains. But wait, there is more. Besides capital gain taxes, people get surprised that they have to pay even more taxes. This is the so-called Medicare or net investment income tax. It stands at 3.8% on both short and long-term investment income. This tax applies to crypto or other capital gains above certain thresholds, as we see here. If you're an active crypto trader, it is a must to keep track of your gains and losses throughout the year. That way you know how much approximately you owe in taxes, and you can set aside money just for that. The government does not care that you made big bucks in 2024, only to lose it all by April 15 of the next year. Either way, you must pay taxes on your 2024 gains. And only then, in 2025 next year, you can deduct your losses on crypto, if any. For 2024, you may get different 1099 tax forms for your crypto transactions. It could be 1099 miscellaneous, 1099K or 1099B tax forms. My biggest advice is not to trust numbers on those forms. There could be mistakes or missing information. 1099 forms are always sent to the IRS. So the government knows that you made money on crypto and they will ask you to pay taxes based on the information on 1099s, regardless of whether there are mistakes or not. Always double-check crypto tax forms for mistakes. If you find any, immediately report them to the platform that sent you incorrect info. That way they will correct that mistake and resend the 1099 form to you and the IRS. And if you don't spot incorrect mistakes, you may overpay taxes, and nobody wants to pay more than what's required. Luckily, in 2025, the IRS will have a new form called 1099-DA for digital assets. That way, things will be a little bit more organized. So, how can you minimize your crypto taxes in the US legally in simple ways? The first thing that comes to mind is to play around with your holding period. We saw that long-term crypto gains get taxed at lower rates. So if you hold your crypto for more than a year, your tax bill will be much smaller. I know that it's not always possible given how fast crypto prices change, but this is one key strategy to keep in mind. Another strategy is called tax loss harvesting. Suppose that you're holding a basket of crypto assets. Some gained, but some lost their value. Tax loss harvesting can turn an investment that lost money into a tax winner. All you need is to sell your crypto sitting at a loss. Then you can replace it with something else. In the meantime, you can use realized losses to offset any gains you have in that year. Here's the beauty of investing in cryptocurrencies. They are not subject to wash sale rule. Wash sale rule applies to stocks, but so far not to cryptocurrencies, which is fantastic. Wash sale rule don't allow you to book a loss when you sell and immediately buy the same or similar investment. The rule applies 30 days before and after the wash sale of an asset that is sitting in realized losses. So the rule requires investors to actually roll over this loss into the cost basis of a newly acquired asset. Well, this is not the case with crypto. Wash sale rule does not apply. Let me give you a specific example of how you would do tax loss harvesting. Consider the year of 2022. Suppose I bought Bitcoin at 46 grand back in March. The price went down to 16 grand by year end. At the same time, let's suppose that my stock portfolio did better and I realized 30 grand in short-term capital gains in 2022 on that portfolio. The problem is that I will have to pay taxes on that gain of 30,000. But here's how tax loss harvesting comes into play. What if I remain bullish on Bitcoin, but I was not too excited about paying taxes? So what I could have done was this. I would sell Bitcoin at $16,000 in December and buy it immediately back at the same price on the same day. I would have realized 30,000 in short-term loss not subject to the wash sale rule. This loss would offset my stock gains of 30 grand and there would be no taxes to pay in 2022. Isn't it wonderful? I don't owe any taxes, I continue holding Bitcoin, but now with a new tax cost basis. In essence, I deferred the taxation of my gains from stocks for later when Bitcoin recovers and I sell it. It's like an interest-free loan from the IRS. There is another way to avoid crypto taxes, and that is to hold your digital assets in tax-deferred accounts like Roth IRA and IRA. Years ago, this was completely unthinkable, but now you can buy and hold Bitcoin, Ethereum, and other cryptocurrencies in your IRA accounts. The catch is that these gains are not available to you until you hit 59.5 years of age. Otherwise, you will be paying a fine of 10% on premature withdrawals. Of course, there is a strategy to avoid this fine, like Roth conversion. So those were my top 3 do-it-yourself strategies to minimize crypto taxes that anyone can do. Of course, there are more complicated approaches. One of them is charitable remainder trust. And this one is beyond the scope of this video, but I just want to throw it out there. To implement this strategy, you may have to work with a professional. There's much more to crypto investing and building wealth. This is what I talk about on my channel every week. Please be sure you subscribe. I'm Andrei, and I will see you next time.